The equity market's response to war usually comes with two components: a rapidly fading response due to fear, and we've already seen that pretty much come and go, and then a potential second long-term component due to economic damage. So in this video, we're going to focus on that latter component, what to watch out for, and where we are in the process already in the conflict between Russia and Ukraine. So let's look at that long-term economic damage in a bit more detail. So what kind of long-term effects should we be looking out for? Well, in a previous video, I talked about the Arab oil embargo in 1973. Now that had both of the components. It had the rapid response, which was falling risk appetite, but it also had the second long-term response, which was economic damage. And in that case, it was due to very high oil prices. And at the time, the US was very dependent on energy imports from the Middle East. And the economic consequence of that high oil price was an inflation shock. Of course, it had other causes, but certainly the oil price was the primary cause of that very high inflation. Now, one of the large market effects of the conflict so far between Russia and Ukraine has been higher commodity prices. And the long-term economic impacts of that in developed markets will be twofold, in my opinion. The first effect will be on households, and that'll be due to the rising rate of inflation. Now, when inflation increases, the effect is to reduce household disposable income. If you're spending more on your gas and electricity bills, then you've got less to spend in shops and on goods and services. And that tends to slow down the economy. So that'll be one effect. And then as investors, the other one that we really care about is based on what happens to corporate earnings. So if the cost of running companies increases due to higher commodity prices, then that increases the input costs of many companies. It also reduces their margins and, of course, their profits. Now, profits are what drive equity prices, so that could have a chilling effect on equity markets. And if you look at the revenue generation for US companies, and this is for the S&P 500, the vast majority comes from domestic sources. So 59% of the revenue for US companies comes directly from the US. And of the 41% which comes from other countries, the largest countries are shown here, starting with China, which makes up 4% of the revenues, and it goes down to Brazil, which makes up 1%. And Russia isn't even in the list. So its source of revenues for US companies is less than 1%. So the direct effect on US corporate earnings of Russia sanctions, but also a weakening of the Russian economy, will be negligible. What's much more important are the indirect effects, and I think that's going to come via inflation. Now, inflation affects sentiment in the US equity market, and on the x-axis you can see the year-on-year rate of inflation going back to the 1870s. And on the y-axis you can see the Robert Shiller CAPE multiple. So when that's high, that suggests a lot of euphoria in markets. When there's exuberance, people are willing to pay a lot more for every dollar of profit which companies generate. Notice how that kind of peaks the euphoria for an inflation rate which is around 2, 3, or 4%. If inflation gets very high, as you can see here on the right of the graph, notice how the euphoria very rapidly fades. So this is what we'd call an equity de-rating, when people are willing to pay less for every dollar of profit which is generated. Similarly, when we get deflation, negative inflation, that's also bad for equity markets. So there really is a sweet spot which is around 2 to 4% inflation. Now, if we look at 2021 and 2022, what characterizes those 2 years is that inflation's very high and multiples are uncharacteristically also high. Somehow inflation just hasn't rattled markets, and euphoria remains baked into US equity prices. So if we do get inflation which is sticky, which remains around for a long period of time, what we might expect is that equity would derate, and it could derate very severely. To take us down to something like a 15 times multiple would be a severe fall for the S&P 500. Now, the lifeblood of the equity market, what keeps it going up year by year, is the profit which is generated by companies. And that profit in turn depends on the profitability of companies, which is their margin. So for every dollar that comes through the door of the company in the form of revenue, how much of that is turned into profits? If we divide one by the other and express it as a percentage, that's called the profit margin. Now that's currently at record highs in the US, or very close to them. In fact, it's the highest it's been since 2008, which is when FactSet started recording those margins. And if we look at the year-on-year earnings growth, that's a profit growth for the S&P 500, we had a big dip during the recession, during the pandemic, and then we had a massive bounce back after that. So earnings have recovered very quickly, but then these bars you can see in red are the forecast earnings starting with Q4 of 2021, and that's looking like it's going to be very high. Normally it's around 9% on average, but then beginning in Q1 of 2022, notice how those earnings growth numbers get very low. Now, part of that is due to margins being eroded by high inflation. So that's why I think if we do have inflation which is high for a long period of time, it could cause a serious headwind for the US equity market, but also equity markets across the world. The largest shocks we've seen so far have been in the commodity markets. So if we look at the performance rankings for a broad range of commodities here in this bottom panel, you can see that wheat is up by about 50% year to date, heating oil by 64%, and gasoline by about 60%, and a broad commodity index, the GSCI index, is up by about 41%. So if you want to watch a video about how to invest in commodities, I've done one of those recently. And then if we look at metals, you can see that coal is up by about 147%, but also industrial metals like aluminium, steel, and some precious metals have also been on the rise. How could those commodity price increases affect household disposable income? Here are the weights for the US consumption basket. So the areas of each of these blocks represents the weight of that component in the typical US consumption basket. So the biggest category by far, as you can see here, is housing. Now that's a market which hasn't been directly affected by this war, but one component of that component has been affected, and that's the cost of fuels and utilities. That's because you have to pay to heat a home, and that in turn depends on commodity prices. Another large component is private transportation here at the top, and that also has a large weight in the consumption basket. And of course, that is directly affected by gasoline prices. And then there are also second order effects for things like food and beverages, because those have to be transported, and that in turn requires fuel. So by increasing commodity prices, what's going to happen is inflation will stay higher in the US for a longer period of time. There's not too much the Fed can do about that because a lot of these shocks are exogenous. They're not things which are endogenous, built into the US economy. They're affected by outside forces. So until this conflict is resolved and these supply shocks diminish, there's no reason why these prices should come down anytime soon. Now, the price shocks in the energy market are some of the worst of all. Now, in the EU as a whole, about 40% of the supply of natural gas comes from Russia, although for some countries, that percentage of imports is much higher. So, for example, Germany receives more than 60% of its natural gas from Russia, and Italy more than 40%. And in the case of Germany, the supply shock has been made much worse by the disastrous decision to close down its nuclear power stations. France, for example, generates a lot of its energy from nuclear power, and so it's been less affected by this crisis. And if we look at the country-by-country returns in US dollar terms since the invasion of Ukraine by Russia on February the 24th, you can see that any European country has been much more negatively impacted than countries which are far away from Europe. So, for example, France, Germany, all the way down to Austria have had negative returns of between about 10% and 12%. The UK, which only gets about 5% of its natural gas from Russia, has only fallen by around 3%. Plus, it has a lot of energy companies in its index. The US market is roughly flat, it's up by about 1%, and the countries which have tended to do well have been ones which themselves produce natural gas or oil or its derivatives, or alternatively countries like Chile, which produce a lot of industrial metals. Now, natural gas is priced on the futures market, and a futures market prices in the delivery point of the contract. So prices in Europe will be different from those in the US, say. And in this tweet from Ryan Peterson, you can see that European natural gas prices are 14 times those in the United States. And he actually questions whether German manufacturing can work at these prices. Then there's the effect on household income. Will ordinary people be able to afford their electricity bills, he asks. But as you can see, the increase in price over the last few days as I make this video have been absolutely shocking. Now, a big driver of that recent spike, which is now being called the Blinken spike by some people, is due to comments from Antony Blinken, who's the US Secretary of State. And what he said was that the US is in very active discussions to ban the import of Russian oil. Now, he says he's trying to maintain a steady global supply of oil. Perhaps Iran will be able to make up the difference, but judging by the spike in the price of oil, markets aren't convinced that's going to be the case. So here's the price of West Texas Intermediate crude going all the way back to 2020. Here's the big fall we got due to the pandemic, which pushed the price of oil to very low levels. But thanks to the Blinken spike, the price of oil is already up by over 50% in 2022. And it's even affecting us here at PensionCraft. We work from home, so we have to heat the house, and we live here all the time and we work here. And our energy costs will be going up by about 40% for electricity and by 73% on our gas bill. Now, for many ordinary people, it'll be difficult to stomach these increases. So certainly the household disposable income, if you're already fairly short of money, will suffer hugely as a result of these price rises. How to navigate your portfolio through this commodity shock has been a lively source of debate in our PensionCraft community. If you want to join that conversation, but also support us and learn about investing more generally, then just click on the link beside me and in the description below me to learn more. Another driver of inflation will be higher food prices. If we look at the global producers of wheat, Russia produces 17% of the global supply, and Ukraine another 12%. So between the two of them, that's just under a third of global supply. In the case of corn, Ukraine produces about 17% of global supply, and Russia just 2%. Now, due to the sanctions, but also the fact that it won't be possible to harvest Ukrainian wheat during the war, that's created a supply shock in wheat, which in turn has made the futures market go kind of crazy. So if the futures market rises too much in a single day, and that means a rise of 75 cents or more, then the market effectively shuts down for a short period of time to allow people to take a bit of a breather. And last week, the market was limit up in 4 consecutive days. And if we look at the price of wheat, you can see that it's pretty much at an all-time record. But there's also a secondary effect here, which is that Russia actually produces a lot of fertilizer, which in turn increases harvests across the world. So over the longer term, higher fertilizer prices will also drive up the price of many crops beyond wheat. So this is a source of inflation which is likely to last as long as the sanctions last against Russia. And finally, we've also seen industrial metal prices spike. And again, this is directly because of the large amount of global supply which is produced by Ukraine and Russia. So any manufacturing companies that require steel, for example, as an input, and here it's focused in Europe, remember, they will see their margins eroded by this increase in prices. So in the case of palladium, it's 40% of global supply. Phosphate rock and potash are used to create fertilizer, and then we've also got these industrial metals like aluminium and nickel. Germanium is used to make silicon chips, and there are also other obscure things such as gases used in lasers to create silicon chips. So Russia, for example, is a big supplier of neon, which is a byproduct of its steel manufacturing. So even things like the IT industry could be affected by these higher chip prices, which indirectly come from these rather obscure commodities produced by Russia. So even just 2 weeks into this crisis, it's very clear that it's had a massive effect on commodity prices, and it's not hard to imagine that that'll feed through into high inflation throughout developed markets, and that'll be quite long-lasting. Now, in turn, that could erode household disposable income and spending and growth, but also erode corporate margins, and that could have a chilling effect on the equity market. I think markets are a little bit too sanguine at the moment. I think the actual impact could get quite a bit worse. But remember, if equity markets do fall, it's a buying opportunity, not a chance to panic and sell. And also remember our Patreon offer. If you want to join our community, we'd love to have you. You can learn more about that by clicking on the link beside me and in the description below me. And as always, thank you for listening.